First, let us understand the scale of what just happened. Heading into late January 2026, silver was in the middle of one of the most explosive bull runs in its history. The metal had started 2025 trading near just $30 an ounce. By mid-year, it had cleared the long-standing $50 resistance level, a ceiling that had held silver back for over 4 decades, tested only twice before, once during the Hunt brothers' manipulation of 1980, and once briefly during the 2011 commodity boom. This time, the breakout held. Silver powered through $50, then $60, then $70, finishing 2025 with gains of over 147% for the year. It was a historic performance by any measure. Then in January 2026, the move accelerated even further. Silver surged from around $71 per ounce at the start of the year all the way to its all-time record of $121.63 on January 29th. That is a move of over 70% in just 4 weeks. And then the rug pull came. Within days, silver had dropped sharply. By February 5th, the price was sitting at $76. It had shed nearly $46 per ounce in roughly 1 week. Even after a brief recovery attempt, touching $84 on February 11th, silver rolled back over and is now trading around $78 as of today, February 16th, 2026. So who or what caused this? The answer involves a combination of pure speculation, macro forces, and deliberate positioning. U.S. Treasury Secretary Scott Bessent pointed the finger directly at Chinese traders, calling the January spike a speculative blow-off. And he is not entirely wrong. Evidence in the futures market suggests a massive wave of speculative long positions piled into silver in late January, driving prices far beyond what fundamentals alone would justify at that speed. When those speculative longs got flushed out, through forced liquidation, margin calls, or simple profit-taking, the sell-off was catastrophic and fast. But here is what is critically important to understand. The speculation did not come out of nowhere. It was built on real, legitimate bullish fundamentals. The silver market has been running structural supply deficits for 5 consecutive years. Global demand has exceeded mine output by an average of 170 million ounces annually. Speculators were not betting on nothing. They were betting aggressively on a real story, and then they overextended themselves. That is what caused the blow-off, and that is exactly why the correction was so violent when it came. There was also a macro element at play. In the days following the peak, U.S. economic data came in weaker than expected. December retail sales unexpectedly stalled. The GDP control group fell by 0.1%. Suddenly, markets began pricing in a faster pace of Federal Reserve rate cuts. That shift caused the U.S. dollar to soften and gave safe haven metals some support, but not nearly enough to stop the overall correction from running its course. So where does that leave us today? Let us look at the technical picture. As of February 16, 2026, silver is trading at approximately $78 per ounce, with a bid of around $75 and an ask near $78. The current price puts the metal right in the middle of a critical battleground. According to updated analysis from investing.com, major support sits in the $69 to $70 range. That is the floor, the level where buyers are expected to step in aggressively if the price continues to fall. Resistance sits at $82 to $84 per ounce. That is the ceiling the bulls need to crack open to signal that a real recovery is underway. More granular technical models from Light Finance identify support levels at $76.45 and $71.31, with resistance targets at $87.54, then $92.68, and eventually back above $100. Their base scenario calls for a correction down to the $76 to $71 range over the next month or two, followed by a measured price rebound. That is broadly consistent with exactly where we are right now. And do not overlook the gold to silver ratio. It currently stands at approximately 74 to 1. Historically, during precious metals, bull markets, this ratio falls to between 40 and 60 to 1, which tells you silver still has enormous relative upside left compared to gold, even after everything that has happened. Now let us zoom out and look at the structural picture, because this is where the long-term story gets genuinely compelling. Silver is unique among all commodities. It is simultaneously a precious metal and an industrial metal, which means it has 2 entirely separate demand engines running at the same time. On the industrial side, photovoltaic solar panel manufacturers consumed over 25% of annual global silver supply in 2024 alone, and that percentage is growing year over year. Electric vehicle-related silver demand jumped an estimated 20% in 2025, driven by sensors, high-voltage wiring, and advanced battery components. And here is a development most people are not talking about yet. AI data centers and artificial intelligence infrastructure are emerging as a brand new demand vector for silver, used in high-efficiency electrical components and thermal management systems. This is not a future story. It is happening right now. On the monetary side, the Federal Reserve cut interest rates 3 times in late 2025, in September, October, and December, by 25 basis points each time. Markets are now pricing in an additional 60 basis points of easing through the the rest of 2026. Lower real interest rates are historically one of the most powerful bullish catalysts for precious metals. They reduce the opportunity cost of holding non-yielding assets like silver, and they typically weaken the US dollar, making dollar-denominated commodities cheaper and more attractive to international buyers. There is also a long-term technical breakout that deserves serious attention. Silver finally completing the $50 level breakout in 2025, after that price had acted as resistance for over 40 years, technically completed what chartists call a multi-decade cup-and-handle pattern. When structures of that magnitude complete, the measured moves that follow tend to be very large. Technical targets derived from the multi-year consolidation point to intermediate levels in the $72 and $88 range, with longer-term institutional models projecting well above $100 through 2026 and beyond. So what actually happens next? Let us be honest and walk through the three realistic scenarios, because the market owes you no guarantees. The bullish case, and this is the one most silver analysts currently favor, is that the structural fundamentals are simply too strong to ignore over the medium term. 5 years of supply deficits, surging solar and EV demand, AI infrastructure as a new industrial consumer, and continued Federal Reserve rate cuts are all pointing in the same direction. In this scenario, silver consolidates in the $78 to $84 range over the coming weeks, gathers momentum, breaks through the $84 to $85 resistance wall, and targets the $85 to $90 zone in the near term. Longer term, analysts like Gold Silver's lead analyst Alan Hibbard are forecasting silver could reclaim and sustain levels above $100 again in 2026, with some more aggressive models targeting $175 or higher if the macro environment plays out as expected. The base or moderate case says silver grinds sideways between $70 and $80 for several weeks, digesting the January shock, before gradually recovering as industrial demand data and Federal Reserve communications provide clearer directional signals. Investing.com's base case sits silver squarely in the $70 to $80 range for the near term, consistent with stable demand trends and ongoing supply deficits, but without a major new catalyst to force a breakout in either direction. The bearish case is the one nobody wants to talk about, but absolutely has to be acknowledged. If the US dollar stages a strong comeback, if the Fed surprises markets with a hawkish policy pivot, or if global manufacturing data deteriorates sharply due to tariffs or a broader economic slowdown, silver could slide toward the $69 to $70 support zone and potentially test the $60 to $65 range in a worst-case scenario. Experts specifically flag 3 metrics every silver investor needs to monitor right now: real interest rates, global manufacturing activity, and the pace of renewable energy expansion. If all 3 deteriorate simultaneously, silver's bull case weakens considerably, and that bearish scenario becomes more likely. There are also specific risk factors every silver investor needs to have on their radar going into the weeks ahead. The first is upcoming U.S. jobs and CPI data. These reports could meaningfully shift Federal Reserve rate expectations overnight, and any upside surprise in inflation or employment could delay rate cuts and put real downward pressure on silver. The second is the U.S. dollar. A stronger DXY index directly pressures dollar-denominated commodity prices across the board, and silver is no exception. Third is China. Treasury Secretary Bessent's comments suggest that Beijing-linked speculation played a meaningful role in January's blow-off, and if Chinese traders reduce their positioning in silver, it could weigh on prices significantly in the near term. And fourth is the overall speculative positioning data, specifically the commitment of traders reports that come out weekly. These will tell you whether speculative long positions have been fully flushed out of the market or whether more liquidation could still be coming. Here's the bottom line. Silver crashed 33% from its all-time high of $121.63 on January 29th, down to around $78 where it sits today. The crash was driven primarily by speculative excess unwinding on top of genuine bullish fundamentals. The structural story, 5 straight years of supply deficits, surging solar and EV demand, AI infrastructure as a new use case, and Federal Reserve rate cuts, has not changed. The technicals point to key support at $69 to $70 and key resistance at $82 to $84. A clean break above 85 would signal the bulls are firmly back in control. The silver market in 2026 is not for the faint-hearted. We just watched this metal gain over 100% in 12 months, then lose a third of its value in under 3 weeks. But for investors who understand what is genuinely driving this metal, who can separate the structural fundamentals from the speculative noise, the opportunity here may be significant. The question is not whether silver goes higher. Most serious analysts believe it does. The question is when, and at what level of volatility you are personally comfortable riding the wave. If you found this breakdown useful, hit the like button and subscribe. We cover precious metals, macro markets, and commodities with real data every single week. Drop your silver price target for 2026 in the comments below. I want to know what you think. Until next time, stay informed and trade smart.